are many reasons I wanted Tim to participate, but primarily it's many years of focusing solely on financing hotels and his reputation in the market and unique real-time understanding of where the market for hotel lending is right now. He's successfully navigated multiple cycles and has found a way to continue doing business during the current climate, which is rare in a way. I mean, he's financed over 150 hotels, total volume of over $1 billion, and may importantly right now, that volume has come from a diverse array of sources. So Tim, it's great to have you on, and I'll turn it over to you. Thank you.
Yeah, thanks for the nice introduction, Rob. Well, hey, good morning, everybody. Appreciate everybody joining this call. As Robert had alluded to, my company's Pinnacle Hotel Finance. Effectively, we're a loan brokerage company that is really solely focused in on debt financing for hotels. So really, hotels are the only sandbox that I've played in for really probably the last 12 or 13 years. So my experience in the industry really kind of goes back to 2007, 2008. Right before the market had rolled over in 2008, 2009. So really my early experience in this industry financing hotels was during the last recession. A lot of the financing that I was doing was through different government guaranteed programs with the SBA, with some USDA backed financing, and then really just trying to find one-off banks during those years that were still lending on hotels. I think it was a good experience for me just starting at that time because there was not a whole lot of capital that was flowing into hotels. So as the market really evolved, say, over the last 10 years, obviously the options for owners and financing in general has developed quite a bit. If I could maybe just, I'll touch on a little bit about what my company really does and kind of the areas that we're focused. So a lot of what we do is limited service hotels, kind of budget economy, mid-scale properties, extended stay, loan amounts anywhere from like $2 to $20 million. Doesn't say we can't do loans higher, but really that's just where a lot of the properties that we do fall in, and a lot of it's multi-unit owners. So as far as the space that we're in with debt, really non-recourse and non-recourse financing. On the recourse side, traditionally local banks, regional banks, national banks, credit unions, other types of balance sheet lenders. And then again, the government guaranteed programs, SBA, 7A, 504, USDA, BNI. And then on the non-recourse side, CMBS on the permanent debt side, and then on the floating rate non-recourse loans that have been active for a number of years through debt funds or non-bank balance sheet lenders, lenders that participate in the CLO market or mortgage REITs. So try to cover a vast variety of different options for owners. I would say really the only field that I have not been in historically with debt is through life insurance companies, through EB5, and not really involved in PACE financing either. So if I could just transition now and just maybe provide a little bit of context as far as where the market has been over the last 10 years, and then I'll kind of segue into where we are now and over the last 90 days. So as I had mentioned, kind of going back into 2009, 10, 11, financing was scarce. Not a whole lot was being done. But as the industry started to perform better, hotel performance was on an upward trajectory. As you got into, say, 2011, 2012, on the non-recourse side, CMBS started to thaw, which effectively meant, hotels were getting done and financed via CMBS. Some of the non-bank balance sheet lenders were starting to dip their toes back in as well. So you started to see more activity with non-recourse lenders. And then on the recourse side, again, I think banks started to get a little bit more comfortable once they were able to prune through some of the bad hotel loans that they had to get off their balance sheets, and just started to see that the industry itself was kind of coming back. And so I think as you kind of rolled through 2011, 12, and 13, and 14, as the market was improving, you started to see this resurgence of lenders coming into the space. And then I guess once you really hit about 2015, the market had obviously been performing well for the most part for a number of years. Lenders were comfortable lending on hotels. I would say it was really a borrower's market, and it has been a borrower's market here for probably the last 5 years or so, all bet for construction financing. And so, effectively, whether it be, again, non-recourse debt, recourse debt, there's just been a number of different options out there for owners to finance, specifically acquisitions, refinances, whether or not they contain PIPs, here for the last number of years. So I think that most folks who have existing assets and were out in the finance markets would agree that it's those properties were probably well received and well received by the lenders that were in the space or looking at their deals for the last number of years. So just kind of transitioning now into where are we at today, and kind of what I mean by today, I mean really over the last 90 days. Obviously, once we got into mid-March, everything has changed dramatically. I would say it was within a period of about a week or two in mid-March, once COVID hit, the lending environment and just the tone of the market changed dramatically. I can tell you that transactions we were working on, term sheets issued, commitments issued, were either pulled, they were put on pause, sidelined, whatever you want to call it, but effectively, I think everybody just stopped and said, let's reassess and figure out, where this is going to go. So the past 90 days, to say the least, it's been pretty grim. Not a whole lot of financing getting done. I think one of the maybe silver linings is you are starting to see hotels in general, I think, starting to perform a little bit better as they get through May and now into June. So, perhaps that starts to open up here to some degree. But just a totally different tone in the market here over the last 90 days. And, talking about some types of lenders and what their responses have been. With respect to non-recourse financing, I'll touch on CMBS first. So effectively, there's no CMBS securitizations happening that contain hotels right now. There is securitizations going off over the past month or so. It's just hotels are not part of those pools. So you have multifamily, some office, some self-storage, industrial, some credit tenant retail. But for the most part, hotels are left out of that basket for now. So really nothing is happening with new originations on the CMBS side. As far as other sort of non-bank, either balance sheet lenders or REITs or debt funds, the ones that I've spoken to over the last few months have basically said they're on the sideline, or perhaps if they're looking at deals, they just have to be kind of low-hanging fruit or gimme deals where it's low leveraged. There's some compelling reason for them to do the deal. But for the most part, I would say most of those lenders are kind of in a wait-and-see pattern as well. On the recourse side, again, what I mean is, local banks, credit unions, national banks, balance sheet lenders who portfolio and service their own loans. I've reached out to several of these types of lenders on different projects over the last few months. It's really quick no's. I would say that I've had some commercial lenders that I speak with who, have given me responses that, basically would say, I'm concerned about even kind of walking down the hall to speak with my chief lending or chief credit officer right now about this type of request, or our credit committees they're not going to be receptive to it at all. And I think a lot of that's primarily due to a lot of the focus for lenders right now is just determining what does their hotel loan portfolio look like going through, say, the next 6 months as they're forbearing, modifying, having to work out, trying to figure out what the health of their guarantors or sponsors are going to look like, and how solvent they're going to be coming out of this downturn. So I think that most lenders, I'll bet, maybe with the exception if you have a long-standing relationship with a bank, and effectively you're presenting them a loan that, again, is very low leveraged, where the property is coming back maybe faster than others. Maybe you can find some one-off deals here or there, but for the most part, I would say that banks are kind of in a holding pattern and just not really open to new opportunities right now. As far as some of the government guaranteed loans, and what I mean by this is really SBA 7A, SBA 504, and the USDA B&I program. That's the space right now that deals are happening. It looks like a shell of what it was just, say, 6 to 12 months ago, meaning that there was hundreds of lenders that were in that space and historically have been. That has shrunk down quite a bit, but there are still lenders in that space that are making loans. Obviously, not all hotel loans fit within those boxes. But that is really kind of where my focus is today. It's really where I see the opportunities to actually get deals closed. And so that's where really a lot of my focus is today. As far as transitioning into kind of when does lending return, or at least my opinion on when things start to come back, I think that this is really going to vary by sector, touching specifically first on non-recourse debt, and I'll talk about CMBS first, permanent financing. I think that the fundamental challenge you have with CMBS right now is the typical hotel is suffering such a dramatic decrease in RevPAR really from March, April, May, and I would think that that's probably on any given hotel going to continue here for the next several months, where the fundamental data point or piece of data that CMBS typically uses to back into a loan sizing or to underwrite has been typically a rolling 12-month P&L. And the problem is a rolling 12-month P&Ls are going to look poor for almost every hotel in the United States for at least, say, the next year and a half or so. And so even if CMBS does start to come back and thaw, you're going to have a problem where a lot of loans simply are not going to qualify. They're going to have debt on the property currently that is too high, and they're not going to be able to get a new loan to pay off that debt. So unless they're plugging that gap with equity, I think you're going to have an issue where CMBS starts to come back. Lenders are open, but there's just not going to be a whole lot of loans that qualify until we start to see, ADR and occupancy levels come back to where they were in 2017, 18, and 19, which, others have kind of voiced their opinion on when that may be. As far as some of the floating rate non-recourse financing options, and again, what I mean by that is mortgage REITs, non-bank lenders, debt funds. There's a variety of these lenders that have been active over the last number of years. I think that those groups eventually that are healthy and have healthy balance sheets will start to dip their toes back into the market. I think they'll sense that there's an opportunity at some point, specifically on acquisition deals, groups that have, a vast amount of capital that are coming in, perhaps acquiring an asset that is significantly less than what it would have been acquired for, say, a year or so ago. I think that's where some of these type of lenders will come in and really see that there's an opportunity to make loans that are on a per key basis much lower than what they would have made, just 6, 12 months ago. And the fact that banks in general will probably be a lot more conservative and just not there to a great extent, I think some of these lenders probably serve to prosper if they're active in that space. And I think historically, if you look back, lenders that typically enter the space when a market's starting to recover usually book really good loans, assuming the market continues on an upward trajectory. I would say lenders that did loans in 2011, 12, and 13 made really good loans as they rode the market up, perhaps more so than loans that were made in 17, 18, and 19. So I do see some of these non-recourse floating rate loans coming back. As many of you probably know, these loans primarily are sort of forward-looking underwriting or pro forma based, so they do not have to rely solely on kind of a look-back underwrite like CMBS does. A lot of these are, sort of turnaround plays, or there's some business plan or story in the deal or value add component where, a group is buying a hotel, they're going to rebrand, they're going to PIP it, they're going to replace the management with a group that's more capable, or some story behind why what the numbers are today are less than what they can be in a year, 2 or 3 down the road when that lender looks to get taken out. So expect that area in itself, again, to come back here a little bit early now, but as we get perhaps later into this year and into next year, I do expect groups to reenter that space. As far as recourse financing, again, banks and credit unions, I think it's yet to be determined. I would say, again, it's pretty grim right now. I don't think a whole lot of lenders are going to be looking to make these type of loans right now. I think, though, as you do get perhaps later into this year, into next year, if lenders are able to see, kind of this upward or inclining RevPAR stats on hotels that, is perhaps some sorts of return to normal, I think that lenders will start to, get back in the space very slowly, though. I think it's going to be very conservative underwriting with, high equity requirements or low leverage. I think they're going to be very particular with who they lend to. I think guarantors or sponsors that have a lot of cash is going to be something that's really focused on, that effectively just kind of can weather a downturn or kind of pull themselves through this, this turbulence that everybody's in right now. So again, would expect those to come back, but very slowly. And I think that lenders overall are going to spend more time, say over the next 6 or 12 months, figuring out, how to protect and preserve loans on their portfolio right now than have an emphasis on making new loans. If I could maybe just now transition into kind of what deals are getting done today. I alluded to this a little earlier ago. Before I cover these programs, I think one of the things to point out is effectively right now, if you finance your hotel, say anytime over the last 3 or 4 years, and you have an attractive interest rate and it was leveraged up to a certain level, I think what a lot of owners should realize is the best loan that is out there for your hotel is probably the loan that's already there. Because again, the idea of taking that loan and refinancing it out right now with just the lack of options that exist in the market, you're going to get a very cold reception from the financing market. So I think a lot of folks are better served to try to work these loans out, perhaps calling Tanya's company on the CMBS side, or just trying to work with their lenders as best they can to try to get these loans worked out, modified, whatever it may be. Because effectively, if a borrower gets put on the chopping block and has to replace that loan, I would tell you that most cases today, that's going to require fresh equity to come in unless the property has been able to kind of weather this downturn and has not been significantly impacted by COVID here for the last 90 days. So just really encourage folks to, unless you have to borrow money right now or unless it's an acquisition, to try to work with your existing lenders to try to work these out for the time being. As far as programs itself, so again, conventional banks, I think that they're going to be few and far between, recourse loans, low leverage, strong cash flow requirements. They're going to look for guarantors that have outside income, those that have high levels of liquidity, but I still expect that to be something that is somewhat of a shell of what it was for the last few years, at least for the next 6 to 12 months going forward. Deals that are getting done, and again, this is really where my focus is here now and over the last, say, 30, 45 days. So the SBA 7A program, deals are happening there. Basically, the fundamental reason behind why the 7A program is still functioning well, as well as the USDA B&I program, is there's an active secondary market that buys government guaranteed debt. That market is still liquid. And so effectively, banks who make these loans, they get a partial guarantee from these federal agencies, whether it be SBA or USDA, and they can effectively sell off a large portion of these loans. They can make a premium, recycle that capital, continue to make new loans. And that secondary market, unlike CMBS, doesn't decide whether or not it's going to take hotels. Effectively, lenders can close hotel loans and sell that. The fact that it has the guarantee from the government, the secondary market buys it regardless of what the asset class is itself. So as far as terms on 7A loans, typically $5 million on the 7A side. Some lenders we do these with will blend in an additional $2 million or so. So sometimes you can take these up around $7 million. So clearly these loans don't work if you need $12 or $15 million. The rates on these loans typically floating over prime, anywhere from upper 4s to low 5s today. The terms on these loans, 25 years, they're fully amortizing, so there's no balloon. There's prepayment penalties for the first 3 years that burn off after year 3. So, they're relatively flexible loans in that respect. One of the highlights of these loans is the leverage component. So typically these go up to 80% leverage. So they're great for acquisitions. If you're buying something, we'll take the price, the PIP, the franchise fee, blend in some working capital, the SBA fee, closing costs. So kind of your fully baked capital stack. And we can typically do loans at 80% of that. So great way to leverage. As far as the guarantors, so anybody that owns 20% or more of the borrowing entity is required to provide a full guarantee on the loan. With that being said, these loans work best for smaller ownership groups. So if it's one person that owns 100% of a borrowing entity, great. If it's a group of, say, 3 or 4 partners that each own, say, 25 or 33%, great. Where these deals become a problem from an eligibility standpoint is when you have like a GP-LP structure where the GP partner owns 5 or 10% of the equity, controls the deal, and you've got LPs in there for 90, 95%. That creates challenges as far as eligibility just because effectively the controlling parties own such a minute part of the deal. And in some cases, you have limited partners who have no intentions of guaranteeing debt. So work best for, again, smaller ownership deals and obviously smaller loan amounts. As far as how you can use these funds, so they can be used for acquisitions, refinances, PIPs in conjunction with refis or acquisitions. We do partner buyouts with those. You can blend in, again, working capital on these loans. And they can be used for new construction, though I would say that's probably not happening here today. As far as the USDA program, so effectively what this program is, for anybody who's not really familiar with it, is it's effectively another federally guaranteed program where a bank makes a loan, they get a partial guarantee from the USDA. The whole purpose of the program is really to kind of cater to smaller rural markets. Really markets that sometimes lenders don't want to be in, where if a lender says, hey, I want to be in a top 100 market, or I want to be in a metro area or kind of a secondary market. The purpose of this program is to show that, smaller rural areas really are not getting left behind. So the USDA has actually a map that you can determine if your property is eligible or not. It's really black or white. You can just Google USDA eligibility map. You can type in your property address. It'll tell you if it's eligible or not. If it is eligible, the terms on these loans, loan amounts typically can go up to $25 million. However, I would say that the majority of lenders in this space typically are making loans up to around 10. As you get over 10, there's additional approval layers you have to go through with the federal government that can be burdensome. And the guaranteed portion of the loan also decreases. So, my experience with lenders is these work well up to about $10 million. Some of the other terms, rates very similar to 7A, prime-based floating rate loans. I'd say all in upper 4s, low 5s today. Terms on these loans can be anywhere from 20 to 30 years. They're fully amortizing loans, so there's no balloons. I would say that the majority of hotels typically receive 25 or 30-year terms unless it's an older asset that's got a shorter useful economic life. Prepayment penalties on these loans, again, some sort of step-down combination where the prepay burns off in the first, say, 3, 4, or 5 years. And then on the leverage side, again, this is another one of these highlights of these government-guaranteed loans, 80% leverage. These work great for acquisition deals where a group wants to buy something and project cost is going to be $10 million between the price, the PIP, and the costs and the franchise fees, and they want to borrow $8 million. So works well, again, with leverage. On the guarantor side, so similar to 7A, any person that owns 20% or more of the borrowing entity is required to guarantee the debt. One of the advantages with USDA, though, is there's no $5 million cap or eligibility max is what you have with SBA. So if you have somebody who owns, say, 3 or 4 hotels that are in smaller markets, effectively they can go out and borrow multiple USDA B&I loans without it having no impact on that $5 million SBA eligibility. And then where these deals can be used, again, acquisitions, refis, PIPs can be part of those. They can be used for some new construction, though I would say, again, that's going to be pretty slim right now. And then really on the 504 side, I'll just touch on this briefly. I'm not seeing these coming back quite so fast. I've had a couple projects out that we've pitched as 504 first liens to banks, and it's been a pretty cool reception here so far. I think one of the main issues with 504 right now is just the whole fundamental idea of a bank that makes a first mortgage that's equivalent to 50% of the cost or the leverage of the project. That is a loan that's part of their CRE portfolio, so it's effectively increasing their exposure with hotels. And as I had alluded to earlier, I think just in today's world right now, banks are looking for a way to kind of trim their exposure or kind of figure out how to preserve and protect the loans they've got on their portfolio more so than add new loans. So again, not seeing as much 504 activity. I would say, though, that as the market does start to recover, I would expect community banks, local banks, regional banks, who are usually the lenders that have played in this space, to start to come back and probably look more into doing these 504 structures more so than just making sort of conventional or traditional real estate loans to hotels. The 504 project in itself, it's great for larger deals. So where 7A sort of falls off in that, say, $5–7 million range, 504 is great if you have a $15 or $16, $17 million project, because that $5 million max US or SBA eligibility limit is only really factored in against that second lien. So effectively, if you had a $15 million project, bank lends you $7.5 million, or first it's 50% of cost or leverage. That second, it's typically up to about 30% of the additional capital stack, is going to be under $5 million in that case. So you can do larger deals, and the rates on those loans are super low right now. Those SBA second mortgages are under 3% right now. Those are 20 or 25-year fully fixed rates. The rates on the loans from banks who make the first, really that's going to vary by bank to bank. It's really a negotiation between, bank and borrower. The terms on those, again, from bank to bank, typically 10 years plus, on some sort of 20 or 25-year amortization. And the guarantor side, again, similar to USDA, similar to 7A, anybody that owns 20% or more of the borrowing entity is required to provide a full guarantee. So again, works well when you have smaller ownership groups. As the ownership groups gets more diverse and larger, it becomes a little bit more of an issue with SBA eligibility. Just transitioning quickly, I'll just touch on construction financing here for 1 minute. I get a lot of requests for construction financing. I would say over the last 5 or 6 years on any given year, probably did a half a dozen construction loans. Anybody who has obtained construction financing over the last number of years would probably agree that it's not easy. It has not been easy to obtain construction financing. I think that with the current environment, it's probably going to be magnified, and it probably gets even more difficult. I just think that overall, it's probably difficult to convince lenders right now, with occupancy levels where they are, why new rooms need to be added to a market. So I would think that lenders who historically have been in that space or been comfortable doing that are either backing away, have backed away, or if they're going to continue to do it, are going to be ultra conservative in what they do, requiring massive equity injections. Then in a lot of cases, these deals won't pencil out just based on the amount of equity that's got to come in. So I would say that construction financing in general is probably going to be difficult here, at least over the next year or so, until we start to see a recovery in the market. As far as just maybe providing a real quick example of a current deal, and this is going to be a 7A loan, because again, this is where most of my focus is right now. It's really what I'm seeing that still is getting done. This is an acquisition deal that we're working on, Southeast U.S. Buyer and seller were originally discussing purchase price back in February, so pre-COVID. Deal got tabled or sidelined just once we hit March, and effectively both parties resurfaced in May, or just about a month or so ago. Buyer is able to get a pretty substantial discount on the price. The reason why the deal works is a couple reasons. Number one is the property itself has recovered dramatically from a low point in April. So you see a large uptick in occupancy in May compared to April. You see a tremendous uptick month to date in June. And so the occupancy numbers, or the RevPAR, really is down, but it's not down that much over where it was during the same period of 19. So, sort of a snapback on that property has been pretty dramatic. Other than that, buyer's got a lot of liquidity, so he puts in his equity to acquire, and he's got plenty of liquidity over and above that. So, if there are any challenges going forward, if there's any sort of turbulence, or the market stays rough for a period, the guarantor can kind of weather that storm. That's an 80% leverage deal. It's a 5% rate, 25-year amortization. So, you know, a fair deal is what I would consider in today's market, just based on the scarcity and the lack of capital. So I think that really that's it on my side. I think the last thing I would just leave everybody with is, you know, I know it's clearly been a difficult last 90 days for anybody in the industry. You know, I guess hopefully everybody is in a position to pull through over the next 6 to 12 months and hopefully finds himself on better ground here sooner than later. So that's all I've got on my end, Robert.